Welcome to Keys and Credit.
Try it again.
Beep. Welcome to Keys and Credit, your no fluff, no nonsense real estate and mortgage podcast. I am Bill, the no bullshit realtor.
And I am Barb, your straight talking lender.
What are we talking about today, Barb?
We're going to talk about refinancing and when it's a good time.
Okay.
So, during COVID, a lot of people did refinance, but a lot of people have bought since then. And maybe they did not refinance during that timeline. But we want to talk about when is a good time to refinance.
When is a good time? When is a good time to refinance, Barb, with Rate Inc.?
Well, so basically what a refinance is, you're replacing your current mortgage with a new mortgage.
Okay.
So new terms and new rate.
Yep.
You'd want to think about maybe refinancing when the interest rates are maybe 0.5% to a point lower than where you're currently at, because that's going to save you hundreds of dollars on your monthly payment.
So say it's only 0.5% lower. Would it be worth it after all the costs that come into refinancing?
It depends.
Right?
If your loan amount is $200,000, maybe not.
Okay.
If your loan amount is $500,000 or $600,000, it sure would.
Okay. I have a question when it comes to the debt, not the debt to income, the loan to value.
Uh-huh.
Okay. So say somebody bought a house with us yesterday and they want to refinance it in 6 months because interest rates went from 6.5 down to 4. We'll just say 4.
Okay.
Okay. We're just roll with it. Would it be worth it for them to do it in 6 months?
It could be.
Right. What about their loan to value? What if they're,
Well, so if they're refinancing a conventional loan and they put 5% down, you can do a rate and term refinance
okay.
at 95% loan to value. So 5% down is 95%, right?
Yep.
And so it's a rate and term. So you're reducing the interest rate, and you may be reducing the term as well, or you could, still be at a 30.
Okay. But it would be worth it just because of the interest rate decrease.
Correct.
Right? Okay. Now, could they pull equity out of their house? So they've been in there for 6 months. Interest rates come down. Is there going to be a lot of equity in there to pull out, or are they just refinance it for a lower payment?
Probably a lower payment. Okay. It depends upon the value at that time.
Sure.
But it probably didn't grow enough, because if you're pulling cash out, you have to be at 80% loan to value.
That's what I was getting at.
So you're not going to necessarily be at 80%. Well, and so your new loan would be at 80%. So you'd really have to be at 70 if you wanted 10% of your equity.
Right. So the 95%, that's just a strict refinance.
Yeah, rate and term.
Okay.
Refinance, it's called.
That's all.
Mm-hmm.
Okay. Mm-hmm. All right.
For conventional.
For conventional. What about FHA?
FHA, you can do a streamline.
Can you refinance one FHA into another?
You can.
FHA?
You can. Mm-hmm.
Just for a lower interest rate?
Correct.
What about VA and USDA?
You can.
You can?
Mm-hmm.
Okay.
So you VA, you have to make 7 payments before you can do what's called a VA
You were telling me that. I remember that
Yeah.
conversation. I'm like, what the fuck are you talking about? What are you talking about?
So a VA IRRRL, interest rate reduction loan, you're just redoing the interest rate.
Okay.
Those, you don't necessarily, you can do you wouldn't necessarily need to provide your bank statements and pay stubs and W-2s.
Well, and VA's super lax when it comes to that stuff, isn't it?
Yes.
I don't want to say lax, but they have different requirements.
Their thoughts are, if your rate is going down and you have made 7 on-time payments, it's only going to benefit you by having a lower rate because your payment's going to be lower.
Yeah, because VA is more for their people than it is for just making money, right?
Correct.
The Veterans Affairs Association, or whatever you want to call it.
Yep.
Okay.
Yep.
All right. When is a good time to well, let's say you need to pull money out of your house for, say, college funds, car repairs, debt.
Mm-hmm.
When's a good time to do that?
When you're at around 70%, depending upon how much money you need.
So how
are we talking 50,000, 100,000 of your equity you need out? It depends upon where the value is.
So how would they figure that out? The 70%.
Well, they could talk to their realtor and they could do a market analysis and say, hey, I think your value is going to come in at XYZ. They can reach out to me as a lender, and I have systems that can look at potentially what the value would be.
So
But of
if
course, it's going to come down to an appraisal.
okay, I was gonna say, so if I did a CMA, market analysis, what that called. If I did a CMA and handed it to you, you could start with that number for a refinance,
Right.
but
But
you'd
once
have to go
again, you're
back to
going
an
to,
appraisal.
yep, you're going to
Okay,
have
all
an
right,
appraisal done.
okay, that makes
You just
sense.
need to know kind of where your value is to see if what your goals are going to work.
Right.
Because you need to look at, okay, my mortgage balance is here. I really need 25,000. The value potentially is going to be here. When I add my mortgage amount plus how much I need plus closing costs,
Plus closing costs.
am I going to be below 80%?
Here's a question for you. So some people need to take out money from their house, from their equity to pay off debt to make their lives easier. Now, when you go to refinance, you can figure in what they're paying off,
Right.
right? So
And what their payments are now and what their
versus
new payment will be.
what they're
So
going
then
to
you
be.
look at what the difference is.
Yeah, because some people they hold up financing or refinancing because of their or selling their house because of their current debt, right? But if you can see, because rate will see the current debt, and they're paying off credit card A and B and car C, you can actually pay that off for them. So
Correct.
you know
At
it's paid,
closing.
and then they can take whatever's left. So now they have hopefully a lower house payment if they did it right. Sometimes close to the same or higher, but they'll have less payments and a little bit of money in their pocket.
Right.
So just because they have that debt doesn't mean they can't refinance, right?
Right. Right.
Because you can pay it off with the funds or the equity from the house, right?
Correct.
And you can see that.
Correct.
So
Yes.
something to think about there, right?
Right.
I mean,
Absolutely.
yeah.
Because if your payment's going down because maybe the rate's a little bit lower,
Yeah.
and let's just say their debt payments were 1,200, and we paid it off,
Yep.
and maybe it increased at 400. Well, they're saving $800 a month that they can then utilize elsewhere.
Right. Yeah.
It helps their budget.
Yeah. So refinancing in certain, so I've never refinanced. I'd always stay away from refinancing just because I want to take my equity from the current house, move it into the next one, so on and so forth. And the only reason I'm in the situation I am now, which we all know what that is because I did that so many times. I never refinanced, right? But when I help people refinance theirs or when they call and they want to, say, buy a new house or do renovations, there's another one too. They'll call and say, hey, you know what? We're thinking about selling. If not, we're going to renovate our house. I'm like, well, let's talk about equity. Refinance, what money you got, all that stuff. And sometimes they have so much equity and their interest rates are in such a different area, they'll pull out 10, 20, 30, 40 grand for their renovation and their payment will be lower.
And then on top of that, now they've, after those renovations are done, they've increased their value.
And now that equity goes right back up.
Right.
So they have that back again to use later. So refinancing, the stigma of should I refinance or I shouldn't, blah, use it.
Well, sometimes people will refinance, especially when rates are lower, and we can do odd terms.
What in the hell is an odd term?
Okay. So
I mean, we have an odd producer.
you bought
You
your
didn't even catch
home
that.
and it's on a 30-year term. So
Okay.
you have 30 years. Your loan is amortized over 30 years to pay it back.
Okay.
You call me and you're
then?
like, all right, well, I've been in my home for 27 years. If I refinance, sure, the rate's going to go down 1%. So it's going to go from 7 to 6.
Okay.
I can do a 27-year loan.
Oh.
So you don't lose any of your traction because
So it's
at
not
the
a
end,
strict, has
Yeah.
to be 30.
not with me.
Ah.
You could go with an odd term. So,
Okay,
and
so
that's helpful. So, because a lot of times you won't want to lose that traction because really at the end
Yeah.
of the day, we want our mortgage gone, right?
And that, if you look at, I don't know if you've ever looked, well, I'm sure you do, the first payment versus the 30th
Oh yeah,
payment.
right.
Or the 360th payment, whatever it is on a 30. $2 in interest, and the last payment you're paying, or sorry, the first one you're paying all interest, and the last payment you're paying like $2 in interest.
Right.
So you don't want to lose that stuff.
No, you don't.
I mean, you don't.
So you can go to odd term, or sometimes maybe you're on a 30 and we look at what the 20-year rates are.
Can you do an odd term on a regular first-time mortgage, like a first?
No,
You can't.
no,
That's just a refinance option.
yeah.
Okay.
Why would you want to?
Because
Maybe.
3 years in interest is huge. That's a lot of money.
Well, I know,
Right.
but where rates are at today, you may as well just go with the 30, right?
Okay.
And especially if you're a first-time buyer, get
Yeah.
in with the minimum, right? You can always pay more towards principal
Okay.
and whittle away your principal.
Sorry, I'm writing that
So sometimes when we look at refinancing, we'll look at a 25 and a 20 and maybe even a 15-year term option and what those payments look like.
Okay.
Depending upon where your rate is today and what rate you could get on a 20-year, you sometimes could potentially have a lower payment or just a little bit above. And I would show you the difference in the interest savings from, let's just say, once again, you're at 27 years, that interest of the 7 years you're saving by going to a 20 plus dropping your rate.
So say someone calls and says, you know what, Barb, I want to refinance my house. I want to do 30 years because interest rates are great. I know what's going on. So this is what we want to do. If you see something better,
Oh,
you're
yeah.
going to tell them?
Of course, we're
right.
going to show
I
all
mean,
options,
yeah.
right? And
So-
if they want to do a 30, that's great.
Right.
Uh-huh.
But you show it to them anyways.
Yes,
You show it to 'em
absolutely.
anyways.
Because
That's-
it's their goals, it's their budget. And
Yeah.
so we want to help
And
them, guide them, you know,
most people,
what's most comfortable
they
for them.
hear all this crap on the internet or through social media or whatever they want.
Yep.
Right? Most of the stuff that you hear is wrong. It is.
Oh,
Unless it's coming straight from, the source. But if you're hearing it from drunk Uncle Bob or whoever else, usually Barb has a better option. Right.
right.
And
We
that's
want to
what,
explore all options
and
because we
that's-
don't want to cut ourselves short.
yeah, like coming back to the debt to income stuff. A lot of people think they can't refinance because they have that credit card, right? Or they have that car loan, But if you pay that off, say your car loan's only 10 grand and you're going to pull out 30 grand in equity. I mean, your car loan's paid off, right? That payment's gone. Your house loan's cheaper and you got a $20,000 check in your pocket. I
Right.
mean,
Right.
you
So really, basically, you're trading your loan for a better deal.
yeah.
Your current
Right.
loan.
Yep.
Right. So interest rate, yes, you should shoot for 1%, but a 0.5% would be, still maybe worth looking at. And maybe you're on a variable interest rate. There is a lot of ARMs that are being sold, and
Why?
maybe sometimes
That-
it's a better deal.
How
So-
is an ARM is an adjustable rate mortgage, okay? And we're going to find out. So my mentality, which is probably most people's mentality, is that they're the devil because that's what happened in the downturn,
right?
right?
Right.
So why are they a good thing?
Okay, so if you have someone moving here from Colorado
Okay.
and they know that they're going to be transferred to New York in 2 years,
Oh.
they would maybe want a
So it wouldn't
variable
matter.
interest rate
It wouldn't matter.
because it's a lower interest rate, lower payment, and they already know in the future they're moving and they're selling their house.
So on an ARM, is it set for a couple years?
It
5
is.
years?
It's usually a 5-year, 7-year, 10-year.
And then
arm.
it starts going wonky to
Yep,
whatever. Okay.
yep.
All right.
So really what you're doing is it's going to be a lower interest rate. You're betting that the rates are going to be lower when you want to refinance.
Okay. So
So that would be one
that would be a good
reason
way. Okay.
why
All right.
you'd want to refinance is to go to a fixed rate.
Okay.
And
Okay.
also, you need to determine too what the costs are versus refinancing. Because,
What do you mean? What do you mean?
well, there is costs associated with refinancing,
So you're
right?
telling me this isn't free? Rate Inc. isn't going to finance your shit for free, Cody.
No, there
Good
is
to know.
costs associated.
Son of a... Hang on, I gotta tell you that one too.
So you have to figure out what the break-even point is.
Okay.
So costs, depending upon the lender, is anywhere from 2 to 6% of your loan amount. Okay, probably not 6, but I mean some. So be careful. Shop around.
Probably the ones that rhyme with Wells Fargo. I'm
Well,
guessing it's
so
those types.
what you want to do is if someone is selling you a song and dance and it seems too good to be true, it may
How
be.
do you know? This is a lot of the shit that we get into.
Well, you want to see. Okay,
How do you know if it's a song and dance?
Well, okay, if you hear like rates are going for 6% and all of a sudden someone's advertising 4, right away you know that they're charging you a boatload in discount points to get that. And
Okay.
there really isn't any 4s
I
in the market
guarantee
right
you
now.
half the people that heard
So-
that don't know what that means.
Okay, sure.
Let's talk about discount points and how they get their 6 to 7% down to 4 because they're not paying for it.
They are paying for it in discount point.
No, the lender's not paying for it.
Correct.
The loan mortgage, is it the mortgagee? Mortgagor?
Mortgagor.
Mortgagor. The mortgagor would be paying for it,
Correct.
right? And they don't tell you that. Here's another bullshit tactics that they use. They'll say, so Barb's going to say, you know what? Our interest rate, our refi rate is, what are we at right now? Throw a number. 6.5?
Sure.
'Kay.
Around there.
Okay, we're going to say
maybe.
around 6.5%. And then the lender that rhymes with Wells Fargo is going to say, you know what? We're down to 4. But what they don't tell you is
You have to pay 6 points to get there.
you got to pay 6 6
6%.
points. You got to pay 6%. That comes out of
So, for
your loan
example, on a
cost.
$200,000 loan, that would be, 12 grand.
Yeah. So 12 grand. So
Just in discount.
so that
And then lender fees and title fees. And
that big discount or that big variance in interest rates that people put out there.
Yep. So just be
it
careful.
costs you
Shop
money.
around.
It's bullshit, is what it is. We're gonna tell you that one too. It's what people don't understand is that costs you a lot of money, but there's so much going on, and there's so much money moving around. It's hard to see that.
Well, yeah, they have
You know.
hidden fees.
Yep.
And,
Even in the CDs, the closing disclosures at closing tables, if they know what they're doing, right? If say the lender knows that they're trying to weasel this stuff in, they can zip right through it, and you don't even know it. It's just part of the loan. It really is, So
Yep. So they'll have hidden fees, or they'll advertise teaser rates.
sorry, I went down a rabbit hole on that
No,
one.
that's
Messed
fine.
up your whole flow.
No, that's fine. And so then you got to also determine how long you're planning on staying in the home. Because if you're planning on staying in the home only another year, because maybe your wife is having a baby and the house is getting too small, then it maybe probably doesn't make
There's
sense.
another question as I throw a pen at you. Is there a prepayment penalty for
No.
early payoff?
Generally, no, depending upon
Or
the loan type.
refinance?
No.
Okay, so if you refinance your home and just to do some improvements to get it to sell, and then
Yeah.
you sell it,
Uh-huh.
they don't give a shit, right?
No,
they just don't
they
care.
don't.
Okay, all right,
No.
all right. See, good to know. Good to know. That's stuff we could use too for people if you're going to list your house and you want to get top dollar. So you need 20 grand to get 60 out of it. You can do a refi. You can do what's another
Well,
one?
or you can do a home equity line
That's
of
what I was gonna
credit,
say. Cash
a
out or
second
something
loan.
like that, or
Yeah,
whatever it is.
home equity.
And there's no prepayment on that.
Correct.
And rate does that as well, right?
Correct.
Way better than everybody else. All I see when I look over here is like half of Cody's face. It's really funny because every now and then he just like pops over.
I'm stuck in the office.
Still here. Still here.
So I can give an example.
Okay.
So for example, let's just say Sarah had a $300,000 loan.
Who's Sarah? Where'd Sarah come?
It's just an example.
Is
No one
Sarah-
we know.
Is Sarah married?
Okay,
Oh,
an
sorry.
example.
Anyways,
Sarah, no one we know, has a $300,000 loan, and she's at 6%.
okay.
Okay, she refinanced to 4.5%, saving $250 a month. But she paid $6,000 in closing costs, so her break-even point is 2 years, because you take the $250 divided by the $6,000, and it'll determine how many months it takes for you to get to the break-even point.
So that's where
in the-
she was when she started.
Yep. So
Right?
in this
Okay.
example, if Sarah's going to be longer than 2 years, let's just say her goal was maybe 5, it would make sense for her to refinance because her break-even point is that 2 years. So those 36 months after, she's going to have a lower principal balance than if she stayed on the same path she was at right now.
And this is why we let Barb do this stuff. Like when someone calls and says, "Hey, Bill, I want to refinance my house. Hey, I have a very limited knowledge of this stuff, enough to be dangerous, right? Enough to get the road paved for you. Honestly, that's about it. But when it comes to the complicated stuff like this, like break even, nobody would think about that. They'd say, you know what? I'm bringing all this money out. This is going to be great. Let's go buy a Ferrari. Right? Barb's going to be like, well, it's going to take you like 37,000 years to break even for that. Is that something you want to do?
Right.
You know?
Because you have to be cautious. What am I using my equity for? Because like you had said earlier, you want that equity for the next home you're buying, right?
Yes. Yep.
So you have to be like if you are going to be paying off short-term debt, short-term meaning credit cards or a car loan, then you also want to be diligent after you tap into that equity that you're not increasing those credit lines.
You don't
again.
start over. You don't start over, right?
Yeah.
I mean, yeah.
Yeah.
So, yeah. I can dig it.
There is a reason to refinance. You just have to be careful. You have to know where your value is before you spend money on an appraisal.
So here
Roughly,
comes the sales
what
question.
the costs
Are you
are.
going to sell them on it? Or are you going to try and figure out what they're doing, if it's a good idea or not?
Oh, I'll definitely tell them if it's a good idea or not.
You're damn right. Or not. Sometimes there is an or not in there. People don't want to hear it.
Right.
They'll call Barb and say, or a lender. Let's say we'll talk about an off lender. They'll call an off lender and say, hey, this is what I want to do. Here's our plan. Is it going to work? A sales lender or a transaction lender or I don't know, goal, like money goal. I don't know how lending works, if you got quotas or what.
Nope.
Well, I'm sure you don't, but I don't know how some lenders work. But if they say, oh, yeah, let's just do it, and they do it, and you just dig yourself a hole.
Well, they're commission based,
There
just
we
like
go.
realtors,
Okay.
right? A realtor may walk you into a buyer into a house and say, "Oh, it's listed at 275. You should offer 315." And if it doesn't appraise, then you have an issue, right?
Yeah.
So, back to refinancing, you call someone, they may be like, "Oh yeah, hands down, this is the best deal for you."
Right.
Look at the rates, look at the fees, kind of do your homework on what you think your house is worth, if it's going to appraise for the goals that you want. If you want to do a rate and term, you should be okay.
And think about that, too. You want to listen to what questions your lender is asking you. Because if they're just asking you, oh, we're not advertising. If they're just asking you questions on how to get this pushed through, right, versus questions from Barb, why are you doing this? What's your plan?
What's your goals?
Is this a good idea?
I'm always going to say, what's your goals?
What's your goals? I mean, pretty simple statement, right?
Yeah.
Pretty simple question.
And your goals are your goals, and it's great. So then
But
it
you
may
can tell
be a
them the
good
consequences.
idea.
You can tell them the consequences of
Yeah.
this action,
Yeah.
right? This is what Barb has seen 400,000 fucking times in the past 10 years, right?
Right.
So this is going to be the consequence of your action. If it's a good one, sweet. If it's not, it's your decision.
Right.
It really is.
It really is.
I
Yeah.
mean, we always say that we work for people. If I tell someone, hey, you know what? Putting in an offer $20,000 over a house is a bad idea, and they say, Bill, do it. We're doing it. I work for you. Barb
Right.
works for you. You know
Right.
what? If this is a bad idea, it's going to work, and you say, do it. At least you told them,
Right.
right? At least
Right.
you told them.
Right.
Yeah. Thanks for tuning in to Keys and Credit, where the only thing inflated isn't the market, it's your knowledge. If you found this helpful, share with a friend, leave us a review. It helps more than you think.
More than you think.